Hi, very good afternoon to ladies and gentlemen. My name is Jun Kit. Thank you very much for tuning in on time. So, for the interest of those of the attendees who have yet to join us, we'll give them another 2 minutes, while they take the time to tune in. So, appreciate your patience in the meantime, and I'll speak to you guys in another 2 minutes. Thank you. Okay, hi. Once again, very good afternoon to all of you who have joined us here online. My name is Jun Kit from Phillip Nova. Thank you very much for coming here to join us on today's online webinar with the title Forex 101, a guide for beginners. Okay, so before we begin, I would like to go through a brief disclaimer. Okay, so the disclaimer here is displayed on the screen. So basically, we want to share that everything that will be gone through during today's webinar session is only for educational purposes only. We hope to educate and get you started on this whole world of forex trading. So we do not, it does not constitute any financial advice because we do not take into consideration your personal investment objectives, your financial situation, or your risk appetite. Okay, so we do hope that you can take this session as a place for you to learn a bit more about forex trading. Okay, first of all, we can take a look at the outline for today's sharing session. So we will begin by a simple introduction to Forex. Okay, next up, we would go through some of the common terminologies in Forex trading because I think for those of us who are still new, some of you who are still new, the Forex, this space may have a lot of the jargons or some of the terminologies that you may not be so familiar of. But be rest assured, once you know what all these basic terms mean, it actually makes a lot of sense and it is pretty simple to understand. Okay, after that, we would also go through some of the mechanics of trading Forex, followed by a simple or quick overview of fundamental and technical analysis. Okay, and then we would move on to our Forex trading platform, Phillip MT5, to demonstrate to you how you can place a trade. Okay, at the very end of this session, I'm happy to share that we will have an exciting promo that we will be sharing with you. So we do hope that you can stay throughout this session, while you learn. And at the end of this session, you will hear about this promotion that we have in store for you. Okay, so the first segment right here. Okay, so what is Forex? So basically, Forex, it is a short form for foreign exchange. Some of us even call it the FX market. Okay, it basically is a global marketplace where various national currencies are traded. Okay, so looking at the definition, it is defined as the giving of one currency in exchange for another one at an agreed rate by both parties. Okay, and the forex market is also the largest and most liquid financial market in the world, with trillions of dollars changing hands every day. So this is not one of the largest. This is the definitive largest financial market in the world, okay? And according to a study done by this Trino Central Bank survey, in 2019, the daily volume of in the Forex market is actually $6.6 trillion. So that is a huge amount of volume that is traded every day. I think this is even a lot higher than all the stock market combined in any given day. So it is really a huge market. Okay, so the reason that it is so huge is because basically everything you see on your table right now, the PC that you're using, the phone that you're using, all these are, are a result of international trade. Let's say Apple, they're headquartered in USA, they outsource their manufacturing to China. So for an American company to do business in China, they need to be doing, exchanging their US dollar to Chinese yuan. And ultimately, when we buy it over here, we import into Singapore, would be, that there's some conversion into Singapore dollars and all that stuff. So basically, international trade is definitely one thing. Secondly, the multinational corporations, the institutional investors, even the governments. So these are all, some big, some small. Everyone's involved in this Forex space. So let's say if you're going for a holiday end of the year, you go down to the money changer, you exchange your money for, let's say, another currency, Japanese yen or euro. So you are also, in fact, participating in this Forex market. So there's a reason it is so huge. All right. It operates 24 hours a day, 5 days a week. So this is a bit different from the stock market that some of you may be more familiar of, whereby you can only trade the stocks when the stock market is open. For Forex, it is operated on 24 hours a day, 5 days a week. And also, if you want to trade Forex, it is a leverage product, which means you'll be using a margin. Okay, so you outlay a portion of margin and then you'll be able to open a position that is much larger than your capital that you've put out. So on this margin portion, I will explain a bit more in detail later on. Okay, if we want to know more about the Forex market, we need to be able to distinguish what's the difference between something that is exchange traded and something that is traded over the counter. Okay, so this concept of over the counter also would give us a better understanding of why and how the Forex market is able to operate 24 hours a day without break. Okay, so let's take a look at the exchange. Okay, so the things that are traded on exchange, these things are, like stocks or futures. These are all exchange traded products. So let's say you want to trade on DBS shares, okay, Singapore shares, DBS shares. You have to go through this central exchange. So in this case, it's Singapore Exchange. You need to go through a centralized place for you to, buy or sell. And on the other hand, someone will be buying or selling from you. Okay, exchange. And this, you are limited by only the opening hours of this particular market. So let's say at night you want to trade some Singapore shares, you are not able to because the Singapore market is closed. Okay, so same goes to all the American shares, the Nasdaq, NYSE. You can only trade when the US market is open. So on the other end, the OTC portion, Forex market, it operates under this over-the-counter concept, whereby it does not have a central location or physical location for the trades to be done. Oops, some slides. Okay, so the Forex market, it is over the counter. So if you look at the graphic up there, you'll be able to see that there are many pots. So all these mean a single point where the Forex can be traded. Okay, and they are spread across the world. So bringing back to an example that I brought up earlier, if you go down to the money changer, you exchange your Singapore dollars to some other currencies, effectively you are already making a Forex exchange transaction right there. So you don't have to go to a central exchange while everybody have to go to this place in Singapore to trade their currencies. Okay, so that is also the reason. That is the reason why we call Forex under the over-the-counter. So there's another type of product that is over-the-counter, which is also available on our trading platform that I'll go through later. It is this thing called the contract for difference. Okay, I will not be going into detail on that because today's session is mostly on Forex. To dive a bit deeper into the 24 hours thing, right, to give you a better appreciation, is that Forex, they are traded on sessions. Okay, because let's be real, practically, let's say the Singapore market, we cannot be possibly out for 24 hours. We still have after working hours. So if we look at the whole Forex trading market, we have to look at the whole world in totality, okay? Because different regions in the world, we operate on different hours. And in Forex market, we begin with what we call the Sydney session, okay? Because we know that any given day, the day will start at Sydney in Australia, that side. Okay, so once Australia they open the market, okay, then we have the Tokyo session, which is the Asian session. After Asian session, we have the London session, which is also the European session, and at the end of it, we have the New York session. Okay, looking at this graph, looking at this table here, it gives you a more clearer picture. So at any given day at 5 a.m. in the morning, okay, so this is Singapore time, the Sydney session, they would begin first, all right? They open market at 5 a.m. and then sometime at 8 a.m. in the morning, so this would be the Asian session. So we will be kicking off in the afternoon, 3 p.m. The London session opens, and in the evening, 8 p.m. the New York session opens. So you see at the end of the New York session, when it ends, the Sydney session will automatically come in. So this would go on and on from Monday till Friday. All right. And then from looking at this timetable right here, or not maybe timetable, this schedule right here, just want to share with you a fun fact that the best time to trade Forex is actually between the time of 8 p.m. to 12 a.m. Okay, the reason is very simple. It is because the euro dollar, this currency pair, it is the most popularly traded currency pair. All right. If you look at the actual opening hours during this time, it is not hard to tell from 8 a.m. From 8 p.m. to 1 a.m. around there. This is the overlap of two of the largest economies in the world. Okay, so it is overlapping between the London session and the New York session. At this time frame, both of these markets are open, so there will be a large number of trades going on during this time. All right. And also during this time, you'll be able to benefit from the high volatility. And also 70% of all the Forex trades actually happen during this period. All right, so moving on to why do people trade Forex? Like, why is it so popular? Okay, the very first reason is because the Forex market is very volatile. Okay, so naturally, the higher the volatility, the higher the chance that you can make a profit or loss out of trading from currencies, right? We invest or we trade in something because of the price movements. There's chance for the price to move for us to make a profit. If you're trading in something that the price doesn't even move for days or weeks, like there's no point in putting your money in there to hope for it to appreciate, right? So a Forex market is a good place for you to ride on those opportunities. And secondly, it is due to its leverage nature. You are able to open a large position with just a small amount of capital. And in Singapore, the regulation states that for Forex trading, we will start from margin as low as 5%. Okay, so let's say for a position that is like maybe $100 or $1,000. Okay, so your initial margin is only 5% of that, which is $50. All right, and by using $50 to open a position that is $1,000, so effectively it lets you leverage your capital by 20 times. All right, you're able to make high profits with minimal capital. But of course, we have to stress at this point that leverage is a double-edged sword, and the answer to how to really make use of this to your advantage is to learn on risk management. Okay, I may also talk about this later on in this presentation, but risk management is the most important thing when it comes to trading real money. Okay, bi-directional. So if you are trading in the Forex market, you are able to go long and short in whatever way that you like. So let's say the market is going up, you can long, you can buy the market. If the currency that you're looking at is going to go down, you believe it's going to go down, you can also sell it. So you can go both directions at any, in a bull market and a bear market, there's always a chance for you to trade. Okay, and lastly, it is the high liquidity. All right, so this high liquidity, it also brings in this concept called the spread. All right, so in the Forex market, it is a huge market. So at any given time, there will be a lot of trading going on. So naturally, the spread will be thin. Okay, so just for those of you who are not very familiar in the Forex trading space yet, so basically the spread is the difference between the bid and ask. So at times when the liquidity, so let's say not many people are buying in the market, like there's not much trading activity, the spread tends to be wide. When the liquidity is high, a lot of activities going on, the spread would be lower. So what is this spread? This spread is basically a cost that you would incur when you trade. So the higher the liquidity, the lower the spread, and therefore the lower of your cost of trading. All right. Okay, so that was a basic introduction of Forex. Next up, I would go through some common terminologies in Forex for you to better understand whatever that you read online or when you're trying to learn. So these common terminologies would be really helpful. Okay, we look at a currency pair. So this is a currency pair. Whenever you look at it, it is always quoted in a pair. Okay, because when you want to measure the price of something, it has to be relative to a price of another thing. So let's say today we talk about, oh, how much is a Bitcoin? It has to be, you'll be quoting it in something, right? So a Bitcoin is maybe like 16K USD. All right, so you need something else to benchmark the value of something. So same goes to the Forex space. When we look at the euro, we would gauge the strength of the euro most popularly by the USD. Okay, so the one on the left is always the base currency. Okay, the one on the right would be the quote currency. Right. Looking at this, you'd be mostly gauging the strength or the value of the base currency. Okay, so base currency euro. Right. A simple concept, okay, for those of you who are not quite familiar yet, when you say you want to buy or long a currency pair, you're basically buying the base currency, okay, and you're selling the quote currency at the same time. So the rationale behind this is that you're hoping for the base currency to appreciate against the quote currency, all right? So to repeat that again, longing a currency pair, you are longing the base currency, which in this case is euro, all right? When you're shorting a currency pair, you are shorting the base currency and buying the quote currency at the same time. So the rationale behind this is that you're hoping for the base currency to depreciate against the quote currency. All right. So this is like, of course, when you're buying the base currency, you have to buy with something. Okay. So naturally, you would be, the other side of the trade all the time. You buy euro, you'll be selling USD at the same time. Okay. Vice versa. When you're selling the euro, you would be buying the USD at the same time. Okay. So it would go both ways. Let's look at some of the most popularly traded currencies. Okay, I think the first one, it would not come as a surprise. It has got to be the US dollar, or some, it is also as known as the greenback. If you read those finance articles or the news, they would call the US dollar as the greenback. All right. Secondly, we have the euro. All right. Also not surprisingly, because the euro consists of many member nations. It is a huge economy. Therefore, a lot of trades go on, and it is one of the most popularly traded currencies. And next up, we have the Japanese yen, the British pound, the Australian dollar, the Swiss franc, the Canadian dollar, and as well as the New Zealand dollar. All right. So whenever people talk about the most popularly traded currencies, these 8 will be it. All right. And then moving on to currency pairs. We would normally categorize the currency in terms of different categorization. So firstly, it is the majors. The majors, they are the most popular one. Secondly, we have the minors. And thirdly, we have the exotics, okay? The 3 main categorization: majors, minors, and exotics. All right. Under majors, there is actually another subsection called the commodity pairs. All right. So commodity pairs, they are still under majors though, but just another extra layer of differentiation. All right. So what are the currency pairs that are under majors? We have the euro dollar, the dollar yen, the pound dollar, and the dollar Swiss franc. All right. And under commodity pairs, we have the Aussie dollar, the dollar Canadian dollars, and the New Zealand dollars versus the US dollars. So these 7 currency pair here, these are all the majors. Okay. And if you look closely, you may be able to spot some similarities, like how come these currency pairs are under the majors. Okay, if you look closely, you would find that a common denominator in all these currency pairs, it is the US dollar. All right, so having US dollar is only the first half of the equation. The second half of the equation to form a major pair is you're pairing a US dollar with another currency that is among the top 7 or top 8 traded currencies. Okay, so if you go back to if you recall the slides before that, we talk about 8 currencies. They are like, euro, Japanese yen, pound sterling, Swiss franc. So if you mix all of that up with US dollar, you would get a major pair. Okay, as simple as that. Pairing a US dollar and with the other 7 currency, popularly traded currency, you get a majors. All right. About the commodity pairs, the Aussie dollar, the dollar Canadian dollars, the New Zealand dollars, and the USD. These are called the commodity pairs because these countries, they are highly reliant on the commodities trade. I think they're the largest producers of the popular commodities. So any moves in the commodities prices, they will have a large impact on this currency. So that's why we excuse me. So that's why we call this currency pairs the commodity pairs. Okay, they're highly influenced by the commodity prices moves. Next up, we have the miners. All right, so the miners, they are the mix and match between the popularly traded currencies without the US dollar. Okay, if you look at the majors, you take out the US dollars and you mix and match the others. These are what we call the miners. Okay, so after majors, the miners are the ones that are popularly traded. Okay, and the next up, it is the less not so popularly traded currencies. So these are called the exotics. So mainly exotics, they are the currency pair that consists of currencies from emerging economies, smaller countries. So things like Hong Kong dollars, Singapore dollars, the Thai baht, maybe sometimes in Indonesian rupee, the Malaysian ringgit. So these are currencies from emerging markets, smaller economies. The trading volume is not as high as the majors and the minors. All right, so for those of you who are just starting out in forex trading, we would recommend you looking into majors. All right, for a few very good reasons. Firstly, it is high volume. Secondly, with high volume comes high liquidity. And as a result of the liquidity that you get, the spread tends to be narrower compared to the exotic, so therefore reducing your cost of trading. All right. And also one important point that I like to share, with those of us who are just starting out, is that by going into trading the majors, the good news is that when you're learning about your own analysis, how to plan your trade at any given time, there will be a lot of analysis or news and tips of analysis done by other people on these currency pairs online. Okay, so you could really just go to any of those financial websites, like a popular one, be FX Street. At any given time, you have a lot of analysis out there for you to refer to for your learning process. Okay, at the end of the day, forex trading, before you start to trade, actually there has got to be quite some learning curve that you have to go through to know the fundamentals, to know what you're doing before you actually start to trade. So by starting out with the majors, you'll be able to get a lot of all that support. Even from Phillip Nova, we do give out a lot of all this analysis, technical levels on a daily basis on our Facebook, Instagram, on our Telegram channel as well. So you do give us a follow on our social media. Okay, also stay updated with the latest currency moves and the trends. All right, moving on, we will be looking at a quote. So let's say if you go on your trading platform, you will be seeing the two quotes. So on the left side, it is the bid price, and on the right side, it is the ask price. Okay, so bid and ask price. So basically, bid, it is the price that you will be selling the currency pair. Okay, and on the ask price, it is the price that you'll be buying the currency pair. Okay, so let's say today you want to long euro dollar. Okay, you'll be looking at the buy price on your right. Okay, this is a screenshot from Phillip MT5. I think he has made it very direct and straightforward for you to see. Okay, if you look at the buy, it means when you're buying, you'll be clicking on that button. Okay, all right. And moving on in Forex, I'm pretty sure you will hear a lot of people talking about this thing called the pips. And the pips is basically the fourth decimal place on the quote. All right, because for us to trade, Forex, it has got to be in a larger notional amount, because the forex, it doesn't move by cents every day. If it moved by cents every day, it'd be too volatile, too crazy, for international trade, for our daily spending, all that. So the movement is actually pretty minute, relatively minute. So we measure the movement in terms of pips. Okay, and then in recent years, because it's getting a lot more competitive, so the spread has got to, the spread is getting narrower and narrower. So therefore, we also have this fifth decimal place, we call the fractional pips, or the pipet. All right. All right, so back to the spread I was talking about. To calculate the spread, it is very simple. You take the ask price, which is the buy, okay, minus the bid price, which is the sell. Okay, and you take that, you do a simple minus, you would get the spread, which is 0.6 pips. As you can see, the spread, or rather the difference between the ask and the bid price, it is really narrow. So what it means is also that when you trade Forex in these days and age, your cost of trading is actually very, very low. And also not to mention that if you trade on Phillip MT5, it is a zero commission trading platform. All right, so you don't pay any commission when you place a Forex trade. And even if you trade, the spread is extremely low. All right, we are very competitive in the market in terms of our spread. All right. And when you want to trade Forex, right, so we are coming to the next topic called the lot sizes. We don't just trade like random amounts like $10, $20. So when you trade Forex, it is normally traded at a specific amount called lots. All right. And this is basically the number of currencies that you will be buying and or selling. All right. There are three lot sizes. The first lot size is a standard lot. We call it standard lot. So it is $100,000 of the base currency. Okay. So secondly, if you scale it down a little bit, it is the mini lot, 0.1, $10,000. And then lastly, micro lot, $1,000. All right. So I think a lot of misconception around Forex trading is that, oh, to trade Forex, you need to have a lot of money. So the answer may not be so true because we are able to trade as little as a micro lot. Okay, so micro lot here, $1,000. This is only the notional value. Okay, so the actual margin that you were putting out is actually lower than this. Like I said earlier, it is 5%. So therefore, with only $50 of margin, you are able to initiate a position in Forex. All right, on the right here, this is a screenshot of the trading platform. Essentially, I'd like to direct your attention to this volume blank here. When you put in 0.1, it automatically, the system will tell you that, oh, you are going to trade 10,000 euro. All right. Why euro? Because this is a euro dollar currency pair. And when you are trading, you are looking at the base currency. Okay, so this is 0.1. It's very intuitive. You don't have to memorize or standardize how much. When you go on the platform, you just key in the volume. Okay, the notional value will pop up right there for you to see. Okay, so not much to worry about. All right, next up, would go through some mechanics of Forex trading. We would aim to answer a few questions. So these are the things like how is money made on a Forex trade? We would do a very simple illustration here. A simple transaction illustration. Okay, next up, sorry, the screen sharing, it has a bit of glitch sometimes. All right, so the first question is how is money made on Forex trade? Secondly is how much money do you need to start trading Forex? I believe I've already answered that just now, but I'll just go through that again. And thirdly, what are the costs of trading Forex? Firstly, how is money made on Forex? Let's take a very simple transaction example. This is for those of you who are more familiar with Forex, all right. But for those many of us who are just starting, I think this illustration is very simple. It's simple enough for us to understand. All right. Let's take a look at the trader's action. All right. So in this scenario where you purchase $10,000 euros, at the exchange rate of 1.18. All right. So the euro dollar, the rate is 1.18. So when you purchase, right, if essentially you are buying $10,000 of euro, okay, this is your cash inflow, like you're receiving a $10,000 euro, and you're paying that for that euro with 11,800 US dollar. Okay, so you long the euro dollar, right? You receive the euro, and you would give out your US dollar, right? Let's say 2 weeks later, you exchange your 10,000 euro back into US dollar at an exchange rate of 1.25. All right. At this point, you'd be giving out $10,000 euro, and in exchange for that, you are getting back 12,500 US dollar. All right. From this, you'll be getting a profit of $700. All right, because you're buying. This is a typical case of buy low, sell high. Right, you're buying at a 1.18. Okay, after that you would sell it out at 1.25. Okay, and this is how you make $700. So just a very simple mathematical illustration for you to understand. All right, how much money do you need to start trading Forex? Okay, at this point we want to bring this up, bring this thing up called the margin. The margin is the amount that you have to deposit to take up a trading position. All right. And secondly, this amount is usually just a fraction of the underlying asset. Okay, it is there to help ensure that if you place a trade down there, you need to have some some upfront payment to make sure that you can fulfill obligation. Essentially, margin is like you put out 5% margin, your own money. The other 95%, you're actually borrowing money to trade. Okay, so therefore, when you're borrowing money, of course, you have to put some collateral, you have to put a margin down there. You cannot be 100% borrow 100% to put as a trade. So what happens when the position is losing money? There's nothing for the broker as a collateral. Okay, so the purpose of the margin is while you borrow money, while you leverage to achieve a bigger position, there has to be some form of margin collateral that you put in the account, to safeguard from the broker's perspective. Okay, so there are two portions of margin. The first one is initial margin, IM. It is the amount required as a deposit when you are initiating a position. All right. So secondly is the maintenance margin. It is the amount required to maintain that position. All right. In Singapore, if you want to trade Forex, the regulation is that 5% margin. So you can only leverage your margin by up to 20 times. Okay, I think this is also maybe MAS's intention to safeguard, like to help the traders manage their risk a bit better. So therefore, you can only trade as low as 5% margin. All right. So let's take a look at how much money do you need to start trading Forex. For a standard lot, which is $100,000, you take that amount times 5%. The initial margin required would be $5,000. All right, looking at the mini lot, that would be $500, and for the micro lot, that would be $50. All right, so I think this table here pretty much debunked all the myths that people say, oh, to trade Forex, or like it all goes like in lots of 1,000. Minimum 1,000. Then after that is a 10,000, 100,000. I don't have 100,000, or I don't have $1,000 to trade in Forex. The good news is you can start trading with as low as $50 now. Okay, and maybe for those who are just starting out, maybe you can start by trading in a demo account, and then you may want to start trading in a micro, smaller lots before you up your account, and therefore you are able to take on bigger positions. All right. Speaking a bit more about margin, essentially it allows you to have a leverage effect so that you can use a small amount of capital to make an investment of a greater value. All right, so 20 times leverage. On this photo here, you're putting out just $500, but with this $500, you are able to achieve an effect of $10,000. Okay, so that's the leverage. So literally a small price change can result in larger profit or losses in your trading position. And we need to always advise caution that it is a double-edged sword. Okay, of course, it makes sense. You stand a chance to magnify your potential wins, your potential profits. At the same time, there is also a chance for you to magnify your losses. At this point, I have to come in again to say that risk management is of the paramount importance. Risk management is very important. Aside from learning all about fundamental analysis, technical analysis, you need to cover your account with a sound and good risk management. So a very simple, a basic one is by setting a stop loss. Okay, so you should always set a stop loss in case the market goes against you. There's a level that you have set there. Automatically when it reaches this, you realize your losses and do not prevent yourself from losing more than you initially planned. Okay, so there's just one portion on risk management. Well, this is a whole new topic, so in this session we don't plan to dive, and we don't have time to dive so much into that. But if you're interested, you do leave us a comment in the comment section, or in the feedback form that will come to you later. You indicate that you'd like to hear more about this risk management. We would have another session just to cater on this. All right, moving on to the next one. It is the cost of trading Forex. Okay, so the main two costs that you would incur, it is the spread. Okay, and secondly, it is a swap. The spread, I think I've mentioned just now, it is the difference between a bid and ask price. And recently, or rather these few years, we have become very, very, very competitive, as low as just 0.6 pips. So on this point, just to note, it is very low, but it is still a cost that you'd be incurring. And secondly, the cost that you would incur, it is something called the swap. Now, at this point, I want to clarify that this swap is not the other swap, the credit default swap, or the interest rate swap. So those are a kind of financial derivative. Now those are those things. this swap, it simply means your financial charges, your financing cost. Okay. Okay, so before we go into the financing cost, I just want to bring in a important concept right here briefly, is that the Forex market, they are all, they have this thing called the value date, which means the transactions on all the spot Forex or precious metals transactions, they are valued at T+2. Okay, so when you place a trade today, the settlement date would be 2 days later. Okay, and this is an exception for just the dollar CAD. The T+1 business days, mainly because they're in the same time zone. So in order for the banks to process the transaction, the T+1 is sufficient. And the reason for the T+2 value date for all the other currencies, because you're looking at trades between the American session and the Asian session. Obviously, we are working in different hours. Okay, so for the banks and all to process the transaction and everything, there has to be like a T+2 value date, for the actual currency to be delivered. Okay, this is a concept called the rollover. So when you would incur this cost called the swap, all right, you would only incur this cost when you open a position overnight, which is over to the next trading day. All right. So in the Forex market, we open at 5 a.m. Singapore time. So let's say if you just trade during the day, if you don't bring it forward to the next trading day, you wouldn't incur any financing costs. If you bring your position overnight, this is when you would incur the financing cost. All right. There is also a bit more nuance right here, whereby if you roll over from Wednesday to Friday, you would incur a bit more value date. But I think due to the interest of time, I have other more interesting things to share. So for this part, I will just skip. But just bear in mind that the swap is basically just the interest rate that you occur when you bring your positions overnight. Okay. Okay, so next one, we would have a brief sharing on fundamental and technical analysis. Before you place a Forex trade, obviously you want to make your own analysis. I mean, if you're looking into that, we have to place a trade. Like, let's say we believe if it's going up or going down, we have to be based on some basis, like why do we think it's going up? Why do we think it's going down? Okay, and to how much we think it's going to go up or go down. So we do this by going into fundamental or technical analysis. All right. There are two types of analysis, two main types, like fundamental technical analysis, or we call it FA or TA. Fundamental analysis. Normally, so basically, this fundamental analysis helps us to shape our trading decisions based on all the macroeconomic factors that are affecting the supply and demand for a currency. Okay. Basically, whenever the price moves up or down, it is all the power and rather the effect of supply and demand. Okay, when there is a high demand for a certain currency pair, the value goes up. Okay, when there is a low demand in a certain currency pair, in a certain currency, the value comes down. Okay, so in fundamental analysis, basically we are looking at all the factors, all the things, the real life events that are happening in the world to determine, oh, this event happens like this. Is this going to cause more demand in this currency? Or if yes, then this value of the currency would appreciate. Okay, and then this fundamental analysis, we also look at a lot about, actually the economic well-being of a country. Okay, because naturally when the economy of a country is doing good, the demand of the currency would also be increased. Okay, more people want to invest in that country, because the economy is doing well. How do we measure the economic well-being of a country? So we rely on reports, okay, on data. So these are the things like the gross domestic product. GDP is a very typical or very classic measure of a country's economy. Okay, we also have inflation, employment data, interest rate, COVID-19 situation, geopolitical events like the Russia-Ukraine war, the Brexit, and all this stuff. So these are all the actual things that are happening in the world that are causing a real change in supply and demand of the things. All right. So normally when you look at all this data, as a rough gauge, right? Because ahead of all this, the release of all this data, okay, so let's say for inflation right here, you'll be looking for this specific or one of these reports called the Consumer Price Index. Okay. There's some other, like CPE. So basically, there are many different reports that will give you a hint of on inflation data. So one of the more popular ones just happened to be a consumer price index, CPI. Okay, for employment data, a very popular one for forex trader, it is called the non-farm payroll. Okay, and for interest rates, you'll be looking at the interest rates decision by the central bank. Okay, so there's always this kind of report that the traders would be anticipating towards. Okay, and then there are two things that can happen. That rather put it very simply, there are two scenarios that can happen. Before any event, there will always be this forecasted figure, this market consensus, whereby everybody thinks that the US inflation is going to be 8%. So there's a consensus. So in the event when the actual figure comes out, okay, or let's say the inflation is higher than expected, okay, so in the event of that, that would tend to have a positive impact on the currency in question. All right. So because of all this inflation, employment, GDP, they are all indicators of the country's economic well-being. So the higher it is, that means that country is healthier. Okay. Then therefore, if it surprises the market, oh, it is better than expected. Okay. So that currency would receive a boost. Okay. On the other end, if the currency of the data comes out to be lower than expected, that would be a bearish for the currency. All right. In this slide, I think I'm talking about a very textbook theory explanation, but as all of us know, currently, the inflation, the US Federal Reserve, they have been increasing the interest rates in order to fight the inflation. And then recently, we are receiving mixed report on, some data. They are indicating that the inflation is slowing down. Therefore, the US Fed would, may also tone down on the interest rates hike. While on the other hand, there are like employment data, non-farm payroll that are showing that, oh, actually the economy is still doing good. So therefore, the Federal Reserve should still remain on their tightening monetary policy course to slow down the inflation. So to put it in simple words, currently, like especially this month, we are quite in a volatile time. Okay, and each of these data, they are data on its own, but I think it will take some time for you to look at this data and then to also have an idea, to be able to link it of this data, what will happen to this and all that stuff, and ultimately how it would affect the interest rate decision by the central bank, and then also how the currency would move. Excuse me. Right, so that is essentially the fundamental analysis. Also, personally, I find that Forex is a very interesting product to trade, because essentially when you trade Forex, you are forced, not forced, like you somehow have to be aware of the world happenings. Let's say there are war in Ukraine, there are some new development in the war in Ukraine, there are some trade war here and there, the inflation in certain countries going high. You would be really aware of all this. So I think for personally, aside from trying to make money out of Forex trades, it gives you a very good understanding of how the world works and how the money works, because Forex is basically the flow of money around the world. Okay, so all these huge the world events, they would move the money, and then to be able to study all these main events and to study how they will shape the currency movements, I think it is a very interesting thing about Forex trading. All right. Moving on to technical analysis. Okay, so technical analysis, it would help us to shape our trading decision using price charts as main analysis tools. So a bit of contrast compared to fundamental analysis. Fundamental analysis, we look at the actual events, okay, the inflation report, the zero COVID policy by China. While in technical analysis, we somehow totally disregard that. Okay, we aim to understand the market sentiments based on the historical price movements. And from there, we would be projecting or forecasting the future price movements, and we are able to determine some entry and exit point. Okay, so one key assumption in technical analysis is that we believe the history would tend to repeat itself. Okay, so whatever that happened in the past will tend to repeat again in the future. All right. A few basic concepts in technical analysis. I would go through some important ones. So basically, this is a candlestick chart. If you look at the chart, there are many types of chart, but this is a very popular one called the candlestick chart. All right. Okay, and this is a candlestick. Okay. Due to the interest of time, I believe I wouldn't spend too much time on this, but a brief explanation. Okay, when you see normally when a candle is green, it is a bullish candlestick, which means that the prices actually increased. Well, a bearish candlestick means that prices actually decreased, okay? And let's say if you're looking at a candlestick chart for the daily time frame, okay, on the daily time frame, one candlestick, it would represent the movement of 1 day, of price movement 1 day, okay? And then how do you read it is very simple, okay? So at the bottom here, you have the opening price right here, okay? And opening price, and throughout the day, okay, throughout the day, we know that the prices have gone up to as high as this point, okay, looking at my mouse cursor right here, and as low as this point, okay. Ultimately, the prices closed up here, which is higher than opening price, okay. So therefore, we have the bullish candlestick whereby the prices increase during this day, okay. So you are able to see the open, the closing, okay, and also in between, where did the prices go, okay. So that the opposite would be applicable to the bearish candlestick, okay. Another very important concept in technical analysis, it is the trend line, okay. It's a different trend. So basically there are three types of trend, you know, there are uptrend and there are downtrend, and there are also sideways trend, all right. And to be able to identify that, I think this is not very difficult. In fact, I think it is very fun in the beginning when you're trying to learn how to do this, all right. To identify an uptrend, okay, which is a very important concept. It is very basic. It is very how to say, it is very basic, but it is one of the most powerful tool in trading forex, okay, or in technical analysis, okay. It is highly applicable, and it is also very simple at the same time, okay. You are able to draw an uptrend by connecting a series of higher highs, okay. So right here you can see I see one high here, then I try to connect them to a second high, connect them to a subsequent higher highs. Okay, I draw one line. All right, so I've gotten the upper line already. I can also try to draw a lower support line, which is I would look for a series of high lows. So this is a low, right? So high, low, okay, low, jump up, coming in low. Okay, so I will connect a series of high lows. Okay, so as long as you have, but this is quite subjective. You have maybe 2 to 3 or 4 points connecting one line. It is considered a valid trend line. Okay, so the opposite will be the same if you're trying to draw a downtrend line. Okay, so you just connect the series of lower highs and lower lows. Okay, you would get the downtrend. Okay, one very important concept in technical analysis, it is this thing called the support and resistance. Okay, so what we mean by higher highs and high lows. So basically, let me point your attention to, let's say, the first photo here on the left. So when the prices come up here, why did it come down? Okay, it is because it is met with a resistance. Okay, when prices reach this level, it simply couldn't go up further and it come back down. Okay, when it go up again, it just comes back down. Okay, so a resistance is actually an imaginary ceiling, that prices just cannot go above. So when prices reach this level, there will be selling interest. Okay, then the selling interest, because the prices, people are thinking it's going too high. Okay, they think it's not sustainable, then they start to take profit, they start to sell. So that is the resistance, all right. And on the other hand, the support is merely an imaginary floor that the prices simply just cannot go below. Okay, and then when the prices reaches to this level, okay, the market will be thinking, oh, the prices are too low, it's very cheap. Okay, I think it's worth it to buy now. So people all coming to scoop up the lows, and therefore with all the buying power, the prices would rise up once again. All right. And this what I have here is a very simple illustration of a sideways trend. Prices go up here, resistance, okay, come back down, support, okay, rise back up. Okay, so they would be moving in this pattern in a channel formation. There are two possible scenarios, when prices reach, support or resistance level. There are two things that can happen. Firstly, the prices, they either conform to the support and resistance. Okay, they either follow, or they would violate that level. Okay, so let's say I'm talking about support. Okay, so let's say if that support is broken, okay, it will tend to move down lower to find the next support. Okay, so put it very simply. So imagine you're bouncing a super elastic ball in this current floor. So let's say you're at the 7th floor. Okay, it is a super elastic ball. You would bounce it, throw it towards the floor. Okay, of course it will bounce back up, right? So when it hits the floor, it bounces back up. The floor serves as a support. Okay, then it bounces back up to the ceiling. It will, it wouldn't reach past the ceiling. So that ceiling would be a resistance level. Okay, So when it falls from the ceiling, when it touches the floor, if the floor is broken, okay, if the ball, just bounce through the floor of your level, it will tend to move on to the sixth floor, which is the floor below, the floor of the floor below you. So basically, it would look for the next support level, okay? And this is one of the way that we can use support and resistance to determine our entry and exit point. All right, if you have learned how to draw the chart, the trend lines, okay, then you can start exploring to draw all these chart patterns. Okay, so some of the more basic or the typical ones, they are like rising wedge, falling wedge. Okay, these are all really textbook examples, and with every chart pattern, historically, they would somehow advise you to set an entry level. Okay, so when prices reach here, okay, you buy or sell, then you set a target right here. So these are all derived from past historical price movements. People have done studies on how the charts have behaved for the past few decades, and when it moves in a certain shape, it will tend to move in a certain shape afterwards. Okay, so this is what technical analysis is. We are predicting the future based on historical performance, and at times it actually works. All right, so that is the basis of technical analysis. Due to the interest of time, I won't be going through all here, but do be aware that there are many chart patterns. Okay, with a simple Google, you are able to see a lot of all that. Okay, all right, so a summarization between the difference between fundamental and technical analysis. Fundamental analysis, they are more for longer term. Okay, so they'll be able to help you to determine the directional view. So in the longer term, is it going to go up or is it going to go down? All right. While technical analysis, it is more for shorter term. While some people use it for medium to long term, it is a lot for shorter term, where you can identify the actual trade levels, like your entry where and then you exit where. Okay, so I think in actual trading, I think most of the traders, I think all of the traders, they would use some form of technical analysis. I don't think we know any trader who trade solely on fundamental analysis. So I would think technical analysis is very important. There are people who could get by trading Forex just by learning technical analysis. Okay, so there's a difference. All right. So a few common mistake. At this point, I'd like to just point out the third one, which is or maybe the second one lah. So this I would like to just re-emphasize my point on risk management. It is very important to learn how to manage your risk. Okay, so once again, that thing is not a rocket science. So there are a few simple parameters, a simple concept. Things like setting a stop loss, or on every trade, you are not supposed to, and as a basic guideline, you are not to risk beyond how many percent of your whole trading portfolio, all that stuff. So it is a whole new topic. It's a whole different topic. It's a large one. So do let us know if you have the interest in learning, and we shall maybe organize another session just on that. Okay. So next up, I'd like to move on to our Forex trading platform. Let me share my screen of the. Okay. So what you're seeing here on my screen, so this is a Phillip MT5 trading platform. It is a zero commission trading platform for Forex, contract for differences, and also precious metals. All right. Guide you through a few simple navigation tips right here. Once you open up here, okay, so by the way, you can either open an account with us to get access for this, or if you're just trading out, just starting out, you can go to our website. You can register a demo. Okay, after registering a demo, you'll be able to have a demo access to this account to maybe play around. All right. This panel here, it is the market watch panel. Basically, it is where you can see all the contracts that you are able to trade. Okay, so from here you can see a lot of all these shares, CFD, contract for differences, and you would also have all the currency pairs that we have. Okay, so since this session is about Forex trading, I would have a simple example on how to drag up a Forex chart. So let's say we look at a USD JPY. Okay, to find the chart, you go on here to type it, dollar yen, you drag and drop. Okay, so you would have a chart here already. All right, you can play around with the time frame. So in this point, you want to have maybe a look at the daily chart or 4-hourly chart. Okay, you are able to play with that. All right, you can customize the appearance of this chart by doing a right click. Okay, go to properties. All right, go to properties, and you're able to change the color by going to the scheme. Personally, I like color on white. Okay, So that I have here. Okay, so this is a candlestick chart of the dollar yen. Okay, at this point, if you are interested in learning about forex trade and about technical analysis, you can utilize some of the tools here, like the drawing tool. Okay, come up here. So this, you draw trend line. Okay, so we can try drawing a trend line here. Okay, so just drag and drop like that. Okay, so we have drawn a trend line here. So this is a trend line. Okay, but anyway, so all this support and resistance, it comes in many forms. So it is not always like a straight line. It can be a slanted line. So as you practice more, you'll be able to find to draw support and resistance in various different ways. Okay, so this is a support line. And if we want to apply what we have gone through briefly just now, I'm actually able to spot a chart pattern right here. This is called the head and shoulders pattern. So you see there's one shoulder here. And if you move on, I'm able to draw a head formation here. Okay. So, and if I move on, this is the shoulder. Okay, so this is a very popular head and shoulders pattern. So what it means is normally prices tend to reverse to the downside after this. So head and shoulders will happen after the prices go up. Okay, so when it goes up one time, it cannot go. Okay, it's the second time it goes up very high, comes back down again. The third time it tries to climb back up again, it cannot go up further, and it gets rejected down. And all this, they are bounded by this support line called the neckline. Okay, so this line is like supporting this formation up here. And when, so bringing back the concept just now, right? I was saying when the prices they hit the support line, there are two things that can happen. Okay, so it's either they are supported on this. You see, they are touched, they don't go below, they don't go below, they don't go below. So the moment that they breach this support level, they'll be looking for the next support. So let's see if we can find the next support. Okay. Okay. So right here we can see that this is the support that the prices has somehow found. So if you try to see, right, at some point this level has been interacted before. So you can see on this cursor right here, it used to be a ceiling, it used to be a resistance. Okay, it cannot go up. Then after that, it come back down. Then it cannot go back up again. So this was a previous resistance. Okay, so now it has become a support. Okay, and then when prices try to go back up again, you can see that the prices have actually stalled in this neckline here. Okay, so it goes back up, so it is stalled here. Okay, so when it is up here, so you see that it gets rejected down. Okay, so this has now become a resistance. Okay, once again, this is only educational purposes only. This is not any financial advice. I'm just demonstrating to you how you can draw chart patterns on MT5. Okay, and then also this is just a chart pattern that I am able to identify on the chart here. Okay, so now that you have done your own technical analysis, you want to place a order. Okay, you can place an order by clicking on a button right here. Okay, new order. Right. Okay, so there are a few types of order. So first is exchange execution, whereby you buy in now at the current best available price in the market. Okay, so there are also another kind of execution method called pending order, whereby you are looking to buy at a later point in time. So you feel that the current price, it is not favorable yet. Okay, you only want to buy when the price reaches a certain level. So by setting all these pending orders, you are able to preset that when the prices hit, it automatically buys and sells for you. Okay, so that's pending order. Okay, so depending on your trading strategy and all that, so let's just take an exchange execution, aka market order. Okay, 0.01 is a $10,000. So in this case, maybe I just put a proxy arbitrary trade. Okay, I sell. Okay, at this point I've already sold, and you are able to see the trade that you have placed here. Okay, so these are the trades that are currently running. Okay, this is one of my existing trades. Okay, this is the trade that I've put in just now. Okay, now that you have this trade open, right? Okay, you can close the trade very simply. Oh, before we close the trade, okay. So we spoke about risk management, right? Risk management. We are able to set a stop loss after we have placed a trade simply by dragging the line here. Okay, you notice after I place the trade, I actually have this line here. Say it says sell 0.01 at this price. Okay, you are able to modify this by dragging upwards, because remember it was a selling order. Okay, if we drag it upwards, it will automatically be a stop loss. Okay, so when you're selling, and if the price moves up, you're actually making a loss. Okay, so if you drag up, you're actually making setting a stop loss. Okay, and conversely, if you drag it down, you are making a take profit level. Okay, that means when the price reaches this level, it will automatically sell for you, buy back for you. Okay, so to realize the profit, and you'll be locking in your profits. And if the price is moving up, the system automatically closes your position to stop you from further losses in case the trend actually just turn all the different way lah. Okay, so that is how you can modify a trade. All right. How do you close a trade? Okay, very simply, you can hover over to the trade tab here. You go on here. Okay, you just click on the X button right here. Okay, X button. You click X. Okay, then there it is. Your position has been closed already. So it is just as simple as that. Okay, so aside from this, also you can explore other things like the calendar. So this is the economic calendar that you are able to track and monitor all the economic events. All right, and you're also able to read some real-time news on this trading platform. Okay, real-time news. Okay, all right. I mean, I mean, this platform it has a lot more functions. So, if you're interested to find more, you can go onto our website. Under Education tab on our website, you are able to see some other user guides on more features on this platform. Okay. With that, I'd like to bring us back to our PowerPoint slide. To summarize, thank you very much for attending today. I hope we did give you a good overview understanding of Forex trading, okay, and also some basics on fundamental and technical analysis, as well as how you can place a trade on the Phillip MT5 platform. Okay, coming on to this portion, which I'm very excited about, it is this promotion that we would like to share and extend to you. You can enjoy this promotion by simply scanning on this code. Okay, so the title of this promo is basically we are inviting you to open an account with us and then to catch the FIFA World Cup. So actually we had this I think since early November, but now I think we are almost towards the end of FIFA World Cup, but it is okay. So essentially what we are giving to you is 100 Singapore dollars when you open a trading account. Okay, after you open a trading account, you would have to fund a minimum of $1,000. Okay, after that, place stocks, CFD, Forex off. Basically, you place a trade of any size. We don't have any minimum size for that. You place a minimum trade, okay? And after that, you would be able to receive Singapore dollars, $100 in your trading account in the form of trading credits. Okay, so a very recap, you scan this QR code, okay, to open a trading account with us. Okay, you fund in a minimum of 1,000 Singapore dollars. Place a trade. We don't limit the trade size of that. Okay, after that, you complete all these 3 steps within 31st December, and then you'll be able to receive $100 Singapore dollars. Okay, you can find more about this information by going to our Phillip Nova website. Move on to the promotions tab. We have all the TNCs and all the relevant links there. Okay, if you are wanting to be quicker, you can just scan on this QR code right now. Okay, so a very just a recap like this moment. Okay, thank you very much all of you for attending to this session. My name is Jun Kit. I had a pleasure speaking all of you today, and I appreciate you staying online. I hope the session was beneficial and educational. In the event you have any questions on Forex trading, do not hesitate to leave us a comment. Leave us some feedback on the feedback form that will come your way, or in any event, just write an email to Phillip Nova. In case if you need any one-to-one coaching on the trading platform, we do provide that. Okay, one-to-one trading coaching on using the platform to trade Forex, we do provide that. And even after this webinar, instead, we will send you a follow-up email containing a recording of this session. Okay, in case any part you'd like to rewind and watch, you'll be able to do that by watching the replay of this webinar. Okay, so I think just to wrap this up. Okay, thank you very much for everyone for attending. We do hope that you have a great lunch today and do enjoy your weekend, and we wish you an advance Merry Christmas and Happy New Year. All right, goodbye everyone. Thank you.